Hey everyone, welcome back. Today, we're diving into a real head-scratcher of an explainer. We're looking at a fascinating mystery in the specialty chemical sector, Paushak Limited. Now, this is a company backed by the absolute powerhouse, the 115-year-old Alembic Group conglomerate. And yet, it's been seeing some wildly turbulent times lately. So, before we unravel exactly what's going on, let's get our groundwork set. Welcome to Stress-Free Investing Analysis Personal Notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. All right, let's just get right to the elephant in the room. 54%. That is the massive plunge this stock has taken. Seriously, how does an absolute undeniable monopoly, one with a pristine, historically zero-debt balance sheet, suddenly lose 54% of its market value, plummeting all the way from 991 rupees down to 455 rupees? Okay, let's look at our roadmap for today. We're going to uncover exactly what happened here. We'll start with their legendary phosgene monopoly, check out their financials in the trough, dissect this massive 175 crore rupee bet they made, weigh the red flags and catalysts, run through some valuation scenarios, and finally, get to the final verdict. Is this a value trap or a generational buying opportunity?
Section 1. The phosgene monopoly, an impenetrable moat. So Paushak is literally India's only large-scale phosgene-based specialty chemicals manufacturer. But what does that actually mean for us? Well, phosgene is a highly specialized, incredibly tightly controlled substance. It's actually classified as a Schedule III chemical under the Chemical Weapons Convention. Because of that, the regulatory barriers to even handle this stuff are sky high. No new domestic competitor has managed to get a manufacturing license to enter the space in over 25 years. I mean, that is a moat you just cannot buy.
And honestly, their historical stability is pretty incredible. Beyond just having a monopoly, Paushak has this pristine balance sheet backed by the Alembic Group. Historically, they've carried zero debt. Their Altman Z-score is 23.1, which basically means they are extremely safe from bankruptcy. And their promoters hold a massive 67.28% stake completely pledge-free. They've been completely clear of any financial manipulation. Section 2. Financials in the trough. The multi-year decline. Now, a 54% stock crash doesn't just happen by accident, right? We have to dig into the severe financial deterioration that completely spooked the market. When you look at the drop from FY23 to FY26, Paushak's revenue virtually stalled out at around 219 crore rupees. Their EBITDA margins got squeezed heavily, dropping from a peak of 35% down to 26%, and profit after tax dropped 20% year over year. But here's the most alarming part. Their free cash flow took a brutal dive, turning deeply negative to minus 122 crores in FY25. That's literally the worst in the company's entire history. Now, this is where it gets really interesting. Think about this contrast. Right now, Paushak's return on capital employed, or ROCE, is sitting at a meager 9%, compared to their estimated cost of capital, or WACC, at roughly 15.5%. Put simply, every single new rupee the company invests right now is actively destroying value because the returns are far below what the capital actually cost. No wonder the market punished the stock.
Section 3. The 175 crore bet, transitioning for growth.
So what exactly is eating all that capital? Well, this is the core catalyst for the financial trough we just talked about. The massive cash drain was caused by a deliberate, strategic, 175 crore rupee investment into their brand new MPP8 multi-purpose plant, which commercially launched in Q3 of FY26. And management has been busy. Alongside this, they executed a 1-to-2 stock split, listed on the NSE to broaden their investor base, and initiated a DGTR anti-dumping probe. Basically, they are aggressively transitioning for growth.
Section 4. Red flags and catalysts, weighing the risks.
You know, transition always brings some serious friction. While Paushak's raw phosgene gas production is highly protected and totally unmatched domestically, their downstream derivatives, the finished chemicals they actually sell, like ethyl chloroformate, face some huge risks. These finished products are bleeding margins right now because of heavy, super cheap Chinese dumping into the Indian market. And that right there is exactly why they triggered that DGTR probe we just mentioned. Okay, so because they're in this messy transition period, we need to know when to pull the plug on this turnaround thesis. If the new MPP8 plant's revenue stays below 10 crore rupees by Q2 of FY27, or if EBDR margins stay depressed below 25%, or if the DGTR probe completely fails to impose those protective duties, or if their borrowings balloon past 100 crore without matching growth, well, then the thesis completely breaks down. Keep a very close eye on these red flags over the next few quarters.
Section 5. Valuation and Scenarios. Pricing the Unknown.
If you're looking to jump in, you absolutely have to know what the market is pricing in right now at this 455 rupee level. Here's the crucial point. At current levels, you're paying around 28.5 times their depressed earnings. You're essentially paying a premium today, just hoping for the base case target of 580 rupees, or the bull recovery case of 850 rupees, both of which rely heavily on that new plant hitting its stride. But if the plant gets delayed, you're looking at a bear case target of roughly 380 rupees.
Section 6. The Final Verdict. To buy or wait. Let's pull all of this together, the qualitative moat analysis and the quantitative financial data. The bottom line is this: buy the moat at a trough price, but only at the right price. According to our scoring models, Paushak gets a 62 out of 100. Look, it's a brilliant company going through a really tough transition. That makes it a solid hold, or a top watchlist candidate right now. It just simply isn't an immediate screaming buy with a large margin of safety at the current 455 rupee price. Now, if you are looking to build a position eventually, a staggered entry strategy is absolutely key to mitigating the massive execution risk of their new plant. Here's how that looks. Step 1, initiate just 1/3 of your position, but only if it dips to the 380 to 420 range. Step 2, add another third once Q1 FY27 confirms the new plant is actually generating over 10 crores in revenue. And step 3, add the final third if the DGTR successfully imposes those anti-dumping duties, giving them back their pricing power.
Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian listed company should I analyze next? Drop the stock name in the comments below and it might be the subject of my next video. Thank you for watching and keep your investing stress-free investing.